Welcome back to the lab. Today we are taking on a massive transition. We're going to move you from being just a standard everyday taxpayer to a highly effective tax strategist. Our theme for this session is Strategic Erosion Control. We're looking at the exact pro-level strategies that the wealthy use to legally minimize their taxes using business and real estate. So get your notes ready, lab members, because we're officially entering the Tax Advantage Lab.
Okay, let's dive right into this by revealing a rather shocking truth that governs our entire financial system. Did you know that in the US, there isn't just one set of rules? No, we actually operate on two completely different tax codes. Most people only ever see the first one, but the wealthy spend all their time operating strictly within the second. It's kind of like the IRS hid the good menu in the back, hoping you just go ahead and order the most expensive item on the front page.
So, here's our experiment protocol for today. First, we'll establish our core hypothesis. Then, we'll run 3 distinct experiments covering real estate, income, and growth. And finally, we'll wrap up with the lab task to put these tax incentives into practice.
Let's start right off with Section 1, the hypothesis.
Our hypothesis is pretty straightforward. Understanding the right tax code unlocks massive wealth. Just look at the comparison. On one side, you have the tax code for employees. Picture this as a tiny, straightforward little pamphlet. It's designed to be simple, sure, but it is incredibly expensive for the person paying it. On the other side, though, we have the tax code for owners and investors. Imagine a massive 4-foot-tall encyclopedia. It's complex, absolutely, but it is essentially a giant menu of incentives. The government is literally offering you financial rewards for acting like an owner.
So, let's see how this hypothesis actually holds up in the field. Section 2, Experiment 1, Real Estate. We're testing what is arguably our greatest tool for wealth preservation, depreciation. Check out this highly specific number, 27.5 years. The IRS allows you to claim that your residential investment property is physically wearing out over exactly 27.5 years. And here is the absolute kicker, lab members. They let you claim this deterioration even if the actual market value of the property is going up.
This brings us to a critical definition for your notes. We call it the paper loss. A paper loss is a tax deduction claimed on a depreciating asset that offsets your actual profit, even when the property's market value is climbing. In the lab, we often refer to this as the phantom expense. It's the exact mechanism that real estate moguls use to build massive wealth behind the scenes while looking completely broke on paper to the IRS.
Let's break down the math to see how this phantom expense behaves in the wild. Imagine you have a rental property. After all your real-world expenses are paid, you make a solid 10 grand in real profit for the year. That's real cash in your pocket. But because of that 27.5-year depreciation rule we just talked about, you tell the IRS that the building is getting older, and you claim a phantom expense of negative $10,000.
So the crucial point here is the result, 0. You made 10 grand in real spendable profit, but because your phantom expense canceled that out on paper, you pay absolutely $0 in taxes on that income. It's entirely legal, highly encouraged by the tax code, and it is a total game changer for your wealth.
Now let's pivot. Section 3, Experiment 2, Income.
I want to ask you all a question, and honestly, you've probably noticed this if you've been hanging around our community for a bit. Why does everyone in the lab have a side hustle? It is not just about grinding for some extra cash. It's because having a 1099 advantage is practically mandatory if you want to stop the strategic erosion of your wealth.
And this brilliantly illustrates exactly why that is. If you're on the standard W-2 path, the formula goes like this. You earn your income, the government immediately takes their tax out before you even see the money, and then you're left with whatever remains for your spending. But on the 1099 path, for business owners and side hustlers, the rules flip entirely. You earn your income, you immediately do your business spending, and then you only pay tax on what is left over. You literally get to spend your money before the IRS ever takes their cut.
This introduces another vital concept you need to know, ordinary and necessary. This is the IRS standard that dictates what you can actually spend that money on before taxes. It allows business owners to deduct things like their home office, internet, software, even certain travel long before the tax bill is ever calculated. Earning 1099 income unlocks these ordinary and necessary deductions that the basic employee code strictly forbids. And hey, you don't need to quit your day job to use this. Shifting just 10% of your overall income into a 1099 side hustle activates this powerful business shield. It lets you reclassify elements of your everyday life into legitimate tax-deductible business expenses.
Moving right along to Section 4, Experiment 3, Growth.
Usually, when you sell an asset, like a stock, for a profit, you immediately owe capital gains tax. The erosion begins right away. But not in real estate. Let's walk through the brilliant protocol known as the 1031 exchange. Step 1. You sell an investment property at a profit. Step 2. Instead of cashing out, you roll that entire profit directly into a new, larger property. Step 3. Because you followed the protocol, you pay $0 in taxes today. You completely bypass the capital gains tax.
In the industry, this unstoppable machine is affectionately known by a specific strategy: swap till you drop. You can do this over and over and over again. You're keeping 100% of your equity working for you. You're trading a small greenhouse for a medium blue house and then a large red building, without a single tax event eroding your capital along the entire journey.
And the ultimate punchline to this infinite compounding loop? The stepped-up basis. You can run this swap till you drop loop forever, and you only settle up with the IRS much, much later. Or, if you hold the assets until you pass away, you pass them to your heirs at a stepped-up basis. This means the tax slate is essentially wiped clean for the next generation. The taxes are literally never paid. The only catch is, well, you have to die to get the ultimate tax break.
All right, this brings us to Section 5 and easily the most important part of our time together, the lab test.
We've looked at the data, now it's time for your actionable protocol for the week, so you can start building your own business shield. Remember, you don't need to own a skyscraper to be a tax strategist today. Here are your exact steps to launch a 1099 side hustle. First, identify one single skill you can monetize right now. Maybe it's consulting, graphic design, freelance writing, whatever. Second, research the home office deduction requirements to see exactly how your current living space can become an asset. And third, track just one business expense this week. Keep in mind, lab members, generating even just $500 this year unlocks these deductions. You just need to start thinking like an owner.
So, I'll leave you with this final, somewhat provocative question based on all the data we've reviewed today. Will you remain a simple, expensive employee, or will you start experimenting with the owner's incentives? The code is sitting right there, just waiting for you to use it. Next week, we're entering the Lifestyle Design Lab to run experiments on how to spend money on the things that actually bring you joy, rather than just surviving. Make sure you hit subscribe so you can keep running these financial experiments with us. I'll see you in the lab next week.